Hey, good afternoon. This is Craig Modelmog with another episode of Wall Street X's and O's. It is Friday, August 14th. Hard to believe we're already halfway through the month. And it's good to be back. Hope everyone's doing well. Loving the heat, baby. When I was in Kansas, reporting from Kansas the last time, the day before we left, the heat index, 105, baby. That makes you tough, let me tell you. But anyway, to kick things off, the opinions on this show, just so you know, are mine. They are not a solicitation or an offer or guidance to buy or sell anything. It is mere information and really reporting on the facts. Investments are not FDIC insured. They can and will lose money. And let's get on to it here. Hey, we got a good show, but to kick things off here, I had a few of you reference my rocking. And saying, Craig, it's really annoying. And I'm like, I know, but it's how I soothe myself. Dogs lick their feet, cats do. Craig rocks, okay? So I have locked, as you can see, my chair, so I cannot rock. Inside, I'm probably terrified right now because I can't soothe myself, but it's okay. It's okay. I'm going to be okay. I can get through this next 12 to 15 minutes, so it's going to be good. But it's all right. So anyway, deep breath. Here we go. I've got a good show today. We're going to talk about unemployment as we always do, but it's just focused on the numbers. I've got a new stat here we're going to hit. We're going to talk about small businesses. We are going to talk about housing. Housing. We are also going to discuss some new bankruptcies. Steinmart, another big retailer, went bankrupt, which is kind of an interesting story. And then we're going to talk about taxes and the election. If there are children in the room, this is your opportunity to tell them that this is not a child show and they should exit, okay? We will not be using any expletives or four-letter words or F-bombs. We will be using five-letter words, taxes, and nine-letter words, I think, 1, 2, 3, 4, 5, 6, 7, 8. 8-letter words, elections. You gotta love that. And then we're also going to end it up on gold. But anyway, let's kick this thing off here. Initial claims. This last week were a little bit better. Claims dropped 228,000 down to 963,000 new unemployment claims. That's still atrociously high. Okay, PUA claims also declined, minus 253,000. Or a total of 656,000 for the week. Continuing claims, which we've been tracking week over week, declined also 640,000, but we're still showing a continued federal government claim of 15.49 million. That's with an M. That's a lot of people. If you look at total claimants, there are 8 different unemployment programs, okay, roughly. The total claimants as of the week ending were 28.26 million, which was down 3.06. It is improving, but you know what? Unemployment still remains very stubbornly elevated. Okay, it's really tough out there. Here's some good things. I'm really looking at duration of unemployment. It's not one thing just to be unemployed, but it's how long of a period of time are we unemployed. This is where it gets interesting. Right now, I'm tracking duration of unemployment greater than 15 weeks. That continues to step higher. These are people that have been unemployed for 15 consecutive weeks. Then there's another ratchet. There's another paradigm higher or level higher. 20, greater than 20, and this is greater than, okay? Let's get back to math class. Greater than 26 weeks of unemployment, okay? These two combined are approaching 8 million right now, which is my best guesstimate or prediction. It is going to exceed what the great financial crisis peak was in the coming month. We will see that in the next month, okay? That is not good news, people. It is just not good news. So unemployment remains stubbornly high. The thing I'm really anticipating, I'm really watching, if you want to know another thing I'm really dialed into, white collar unemployment. Thus far, we've seen minimal, okay? And I'm also going to work on saying, okay, it's a transition word. I have to come up with other words. I'm telling myself this. See, I'm trying to get better. We're always trying to get better. That's what this show's about. We're getting better. All right. See, there's a replacement word. All right was for okay. So I'm doing better. Hmm? Yep, I almost said it again, but I didn't. Anyway, here's the deal. White collar unemployment really has not surfaced yet. That is what I'm really anticipating will surface. To what degree, that is really going to be the kicker. Okay, let's get on to small businesses. Here's another good stat: PPP funding, which that's the Pension Protection Act that was really dialed in for small business owners. Okay, as of July 21st, so that's looking 3 weeks ago. Today is August 14th. So 3 weeks ago, 71% of all small businesses that took PPP said they had exhausted it. That means there are 29% that have funds left. That is it. All right. Half of small businesses said that they will need additional financial support over the next 6 months. Half. Okay. That's 50%. That's a lot of people. That's a lot of businesses. In a separate American Express survey, so this is American Express, the credit card, they surveyed all their business owners that utilize their card. They found 62% of small businesses said that they need consumer spending to return to pre-COVID levels by the end of the year, or they will not make it. Let me say this again. 62% of all small business owners surveyed by American Express said that if consumer spending does not return to pre-COVID levels by the end of the year, they will not make it. That is serious, okay? I'm going to wave the flag for the small business owners here in Fort Collins or wherever you are located, okay? I want you to go out and support your small businesses. They need you. They need us. Okay. They need us to go out there and spend some money. They need us to go out there and access their products and services. So I'm gonna put a pitch out there for them. Okay. Moving on here, housing. Here's a word I'm guessing no one has ever heard of in their lifetime. They may have heard of it because you're going to know what this is, but it's never been used in the context I'm about ready to use it in. You're getting excited, aren't you? Here's the word for the day: de-urbanization. You're probably thinking, Craig, seriously, de-urbanization, that's your word for the day? It is the word for the day. But it's okay. Here is what's happening. And this is, we're going to zero in on New York City as a specific. I'm also hearing this is happening in Silicon Valley, in some of our major metropolitan areas. What we're seeing is because companies have sent people home, COVID, go home, work from home. Now they're saying stay working at home. They're starting to look at what they were spending on their footprint and how much footprint they had. They're like, we can save money. We may not need as much space. So what you're seeing now is people are going, wow, I lived in the city and I'm paying X for rent. Why don't I move out of the city and pay Y for a mortgage and have a different quality of life, and I don't have to drive in the city? Here's what's happening. In a couple counties up in and around New York City, Fairfield County, which is close to, it's a Connecticut suburb. I don't know the East Coast, so I don't even know where that is. And then Westchester. In Fairfield County, we saw a 73.4% year-over-year increase in the month of July in single-family sales. In Westchester County, Westchester, it's kind of cool to say, that county was up 112% year-over-year. So people are saying, see ya, I'm leaving New York and I'm going to go live in the burbs, okay? This is going to be another very interesting thing to track. Very interesting thing, okay? Let's look at bankruptcies. On to bankruptcies. Steinmart, latest victim, 35th big box department store. They are saying that that right now bankruptcies are approaching the worst levels we've seen in 10 years. What happened 10 years ago? Financial crisis. Year to date, 420 companies have filed for bankruptcy. All right. I'm anxious to see how this continues. My expectation is continued filing for bankruptcy. My son who works for Ernst & Young, he is a corporate tax CPA. He specializes in corporate taxes. He goes, Dad, what I'm seeing is companies are letting people go, white collar and blue collar, both sides, and they're focusing on what tax benefits that they can achieve or accomplish, doing look backs. So they're going back and they're doing recharacterization of old tax returns, trying to pick up tax benefits, and they're laying people off. It is a cash flow. Weeks ago, I talked about the problem we have is solvency. It is not liquidity. The government has flooded the market with with cash, almost 5 trillion with a T. That's not a technical, that could be a technical foul. I'm going to tee the government up for issuing too much cash, okay, which I'm going to talk about taxes and election next. But anyway, what companies are doing is they're looking at shoring up balance sheets. They're looking at shoring up cash. They're trying to minimize expenses of operation. It is liquidity, people, all right? We've seen lots of different industries that are in trouble. What have they done? They floated new bond issues. Hey, how do you fix a corporate credit problem? It's a debt problem. Oh, you issue more debt. Makes sense, right? No, it doesn't. Moving on, taxes and the election. This is a loaded dang question here. I don't think anyone will argue that the response to COVID was needed. They had to provide some cushion. They had to prop this up, right? The key is how big, and how big do they need to go? The government has really gone big. They are all in. They've already done almost 5 trillion plus or minus. I've lost count because I can't count that high. Right now they're bickering over a bill. Is it 1 trillion? Is it 3 trillion? Is it 2 trillion? You know, it just has a T, another T, technical foul. I'm going to tee you up. I'm going to throw the flag. That's what they're talking about. Here's the problem. Right now, our deficit as a percent of GDP is greater than it's ever been in the history of this country, okay? Here's what the problem with that is. When you get to having a debt problem, there are 2 ways you can do it. One, you can reduce debt. You can do that. You can cut spending, okay? If I'm an individual and I have too much debt, I'm cutting my spending because I'm servicing my debt. So here's the problem. When you look at the government's budget, and I'm going to look at my cheat sheet up here, a majority of the government spending is on Medicare, Medicaid, Social Security, defense, and interest on existing debt. Let me review that. Medicare, Medicaid, Social Security, defense, and interest on existing debt. Moving forward, we know we're in excess of 20-some trillion, okay? They've issued 5 and change since March. They're going to issue more. This is going to put a significant clamp on our government's ability to spend and do things. So what do I think the result is going to be? And this is regardless of who wins the election in November, okay? The Democrats are already floating their tax policy. It's basically a rewrite of Trump's. Trump's talking about some tax policy changes. It's mainly in the form of capital gains, maybe some payroll stuff. Here's the thing. I'm predicting, okay, and am I this great prophetic person? Absolutely not. But when I look at the problem, how you solve this is by raising taxes. The government has to increase their cash flow. They can't keep going this far into debt as a percent of GDP and continue to function and operate. It's just too challenging, okay? So I haven't said it for a while, but I said it again. I'm going to work on that. No, okay. So anyway, the challenge is this. As we are working through this market cycle, okay, I'm going to get my other cheat sheet here. And I said it again, damn it. Anyway, the further we get from the further an economy gets from its cycle highs, which were back at the end of 2018, beginning of 2019, the slower it moves through, or the longer it takes to complete the full economic cycle, all right? If you look at planets circling around the sun, you're getting a science lesson here. See, I even just tried to rock, and I probably hurt my neck on that. I'll probably wake up tomorrow and my neck's gonna hurt. I'm gonna wake up in the morning and go, oh geez, and Tiny's gonna be like, oh, you're terrible, you're falling apart. I'm like, I know. I was trying to rock and I whiplashed myself. Anyway, the further a planet is from the sun, its orbit takes longer, right? That's science. From an economic standpoint, the further an economy moves away from its cyclical high, the longer it takes to complete the cycle. We're trying to complete this economic cycle. We've been extending it due to government bailout, QE1, QE2, QE3. Now we were raising interest rates, pandemic, corporate credit crisis, flooding of the government with more dollars, okay? We're extending the cycle. And the further we get away from that high, again, Q4 2018, Q1 2019, the longer it is going to take us to move through this cycle. This is going to be challenging, okay? I want you to hang in there. We need to continue to hunker down, All right. If you get to gold, gold has been a good thing to own right now. Why? We have a US dollar that is being devalued. That means currencies relative to the US dollar are getting stronger. Commodities, that being gold, what denomination do they trade in more often than not? US dollar. As the dollar goes down, the value goes up. They are inversely related. It's the teeter-totter effect. Many of you have seen me do this in person. Now you're seeing me do it on X's and O's. As the dollar goes down, commodities go up. Do you know that the value of groceries have gone up almost 4.2% just since March? We're seeing inflation begin to rear its head. Okay, gold I think has become a little bit of a momentum play. I think it's why we've seen the volatility this week. I'm not worried about it. I think that goal is still going to be in place because we got a dollar that's going to continue to go down. The dollar was down all week. Okay, it was up a little bit last week. Did some repositioning, bought some more gold, bought some more commodities, did a little bit on the short dollar side. We're going to continue to stay the course. We're entering a stagflationary period where we have growth decelerating and going down. We have inflation going up and accelerating. Okay. How do you combat that? You own commodities. You own Treasury inflation protection notes, TIPS, because it's tied to inflation. You own gold. You own technology. You own real estate, REITs. You own utilities. All right. We're going to continue to manage our portfolio and manage our core based on the economic environment. And by doing that, we are going to keep our eye on the ball. We are going to keep making good, sound, fundamental decisions based on the macroeconomic numbers, the math. Friday, August 14th. This is Craig Modelog. It's been great to see everyone. Everybody enjoy your weekend. Keep hanging in there. I appreciate you tuning in and listening. And until next week, I am out.